Hey, good morning, everyone. Marty Mazzori here, June 23rd, 2023, Friday, with your weekly economic update. I was able to get this done earlier than usual today. Still have a lot left in our week or end of week macro deep dive to do, and other things that look like we need to really intently focus on today, or at least I do. So I thought I would just get this part of my things to do list out to you. It's going to be interesting, this little presentation I'm going to do for you, because things look like they're looking up in terms of general overall economic conditions, which kind of flies in the face in what we're seeing this morning in markets and what we saw overnight, globally speaking, with the purchasing managers indices. So I'll speak to that as well. In front of you is the chart of our PWA index, and as you can see here, we've had quite the bump here the last few weeks. It's been bumpy, but we're negative like 17.7 right now. Now that is still firmly in the territory that says recession is likely coming in the not too distant future, but it's moving in a good direction, right? It's moving back towards the zero line or towards positive. What I'm going to do now is, of course, tell you why that's the case, and then I think probably bring us back down to earth in terms of what's really going on under the surface. So where we saw the big improvement was in the housing space. Here is housing starts for May, and boy, that is just a massive jump. Here are housing permits. Not the massive jump that we saw in starts, but a pretty good jump. Now, I'm going to borrow from Peter Bookvar. He does as good a job as anybody in articulating the under the surface reality of much of the data. And here's his comment on housing. Housing starts in May were well above the estimate, but they were partially offset by a downward revision of 60,000 in April. Single-family starts jumped to just under 1 million at 997,000 from 841 in April, and that's the most since last June. For perspective, it was 1.04 million in February of 2020. Multifamily starts also added to the monthly upside, as they totaled 634,000 versus 499. Permits for single-family homes rose to 897 from 856, highest since last July. It was 986 in February 2020. Bottom line, and this is what I wanted to get to, we know that new home sales are taking greater share from the existing home market in terms of transactions because of the supply imbalances, and that really largely explains it. Also, builders are better able to cushion the price and mortgage rate blow. In the latest home builder survey, 56% of builders offered incentives to buyers in June, which is slightly more than in May, but fewer than in December. With regards to price adjustments, the average price reduction was 7% in June. With existing homes, we're still seeing price wars with 7% mortgage rates and so forth. So folks obviously just don't want to give up their 3% mortgage. So you're not seeing much come to market. There are people who are out there to buy, and the buyers just kind of overwhelm the sellers of existing homes right now. And of course that makes the new home market look pretty attractive. So while we want to score it properly, we want to view it for what it is, which is indeed a positive, we don't want to overemphasize it because there is this lack of supply, which is largely a function of these very high mortgage rates. And then the Home Builder Confidence Index now is back in expansion territory. Now, when we get to things like jobless claims, on the other hand, we continue to move in a direction that we tend to move, if not worse in some cases than, leading to recessions, right? With very few exceptions, maybe one right here, right? But yeah, so there are some exceptions, but this is beginning to look problematic in terms of what it says about the economy. Now, on the other hand, continuing claims actually dropped a little bit last week. So these are, folks who are staying on unemployment. Now, you could argue that people are finding jobs quickly, therefore the continuing claims has gone down. Or you could say some of this is just long-term people and their benefits have expired and therefore continuing claims are down. Probably a combination of the two, I would guess. Okay, so now we get to something that is just really ominous as it relates to the economy. Leading economic indicators came out, and this is our ratio of leading to coincident indicators. And this morning I drew this line, and historically, and this is going back 73 years, we have never had this level in this ratio ever without being in recession. Well, maybe coming out of it, but as we descend into this level, right? As we descend into this level, we have never gotten this low without being in or on the cusp of recession. So this could be the first ever false signal, but we're not betting on it just yet. When we break out the two that make up the ratio, right? The leading and coincident. The coincident is the purple line. The leading is the green line, right? Never had leading indicators descend to this level ever without being in recession or about to get into recession. Actually, in this case, without ever being in recession, except for right now. Coincident indicators actually ticked up a little bit. And that makes sense given that our index, right, just ticked up a little bit as well. But the overall scoring, which takes into account longer leading indicators as well, is saying that recession is more likely going forward than a resumption or a continuation of the current expansion. 100%. These all could be false signals this time. It's a different world out there. Remember, between fiscal and monetary stimulus around COVID, trillions upon trillions upon trillions of dollars were thrown into the economy, and there's still some of that excess savings in there floating around as well. At a minimum, you would expect it to extend the cycle, but certainly distort it in one fashion or another. The Chicago Fed National Activity Index dipped back into the red. I don't like the trend here either. This is an index within our index, 85 data points, 39 now score positive, 46 of their inputs score negative. And by the way, while I'm at it, we have 45 inputs in ours, and right now 27% of them are positive scoring, and that's up 5% from the previous week. 44% are negative, and 29% are neutral. So it's getting better, but it's a long ways from good right here. And then I wanted to also speak just to inflation prospects, right? And again, as we start to see things look up a little bit, and one of our scoring exercises that I've yet to do is our financial conditions index. And that's actually been improving lately. So financial conditions have actually been getting easier at a time when supposedly the Fed wants to keep them tight. So easier financial conditions outside of a recession, and we're not in recession yet, will lead to higher inflationary pressures, as you're seeing here in the 2, 5, and 10-year CPI swap rates. Okay, so this goes out a ways, and you can see it's lower than it was, still higher than it was, right, and still above the Fed's target. And over again this week, when Powell was speaking to Congress, he sure seems firm on that 2% inflation target. We do have favorable base effects for another month. I talked a lot about that. That may make for a soft number when June's number comes out in early July. But the overall trend is, somewhat concerning. So we have a real problematic setup for the market. Again, I can speak to easing financial conditions. That's bullish for stocks. A little better score on our index. That's potentially more bullish for stocks. But if we don't have that slowdown and things begin turning and financial conditions really begin to get easy, Fed doesn't go anywhere in terms of easing conditions. They're going to stay tight. And he said this week he expects to raise rates 2 more times this year. So if the bulls are right and the recession light is no longer lit, well, that means the inflation light gets lit, and that's problematic for asset prices as well. So really tough position, to say the least, right here. And then last, I just wanted to throw up copper, speaking of inflation, but also speaking of economic activity. Copper really got scary there for a bit, and we're seeing quite the ramp up here of late, and it's back above its 50-day moving average. So that went from a negative to a neutral as well. So that helped the score. It wasn't only housing this week. But again, higher copper prices, right, ultimately could mean higher inflation. And copper, it's considered the economic barometer, and I don't disagree, but it is very sensitive to goings-on and even rhetoric in terms of what futures traders do to the price coming out of China. And while Chinese stocks have had a really rough week, and the Chinese economy is showing some real weakness, the rumblings of what's to come in terms of stimulus, it seems to be that the first half disappointment is very unwelcome to some key Chinese figures. Now, whether or not they can convince Xi to really, pull out some stops on some of the constraints that they put on the economy, of course, that remains to be seen. But make no mistake, Chinese officials are paying very close attention to their lack of performance this year, and it would not surprise me to see something not small come from the fiscal end to boost the Chinese economy in the second half of the year, and maybe copper futures traders are sniffing some of that out as well. And that wouldn't be bad for the global economy, but it wouldn't be good for the inflation setup either. With regard to the global economy, overnight, purchasing managers' indexes came out across Japan and most of Europe, and on balance, they were, I don't know if I want to say abysmal, but they were really ugly. So sentiment among purchasing managers around the globe is deteriorating here, or it has over the past month, at a time when we're seeing massive inflation still in the UK, and we're seeing central banks continuing to tighten monetary policy across the world. So again, kind of the worst of both worlds when you look at it that way. Clearly, the powers that be in the central banking space, maybe more so in other places, aren't as worried about forcing a recession or working through an existing recession as they are about the negative impacts of inflation if it gets embedded on a longer term basis. So a lot to play out. It's amazing how well equities have done, but keep in mind in the US it's just a handful of equities. Globally, it's been pretty good, but stocks are quite a bit cheaper throughout the rest of the world. But it would not surprise me, again, to see a global risk-off move here over the coming months in response to this macro reality that we keep illustrating for you here. All of that remains to be seen. We'll remain objective, open to all possibilities, and continuing to do the work and share some of our findings with you here on the blog. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Take care. Bye-bye.